It's Brian Preston, the Money Guy.
Let's go on to Kevin's question from YouTube. He says, recently, you guys said for people in their 30s to prioritize student loan debt greater than 5% interest. Mm-hmm. Does the same apply to mortgage debt above 5%? And do you classify this as high interest debt in the financial order of operations? Because that high interest debt is actually the last step in the order of operations. So what do you think?
AJ, who's one of our financial associates, came down with a question like this the other day, and I was like, look at him trying to catch us. But here's the thing. This is why I love the financial order of operations is that, and this is why I never worry about, is there going to be an automated way that you can just do what Brian and Bo do and the team of advisors we have here at Abound Wealth? And the answer is no. Nope. Because this stuff is very customized to you as the individual. And I know that anybody who saw us talk about that student loan thing, I should have probably foreseen that this was going to roll over to mortgages. But guess what? Mortgages are more complex because what do on our behavior when we have mortgages? They let us itemize. You get to take the interest and it's deductible on your income taxes. Well, guess what that does? Even if you're paying 5.5% mortgage interest, more than likely after taxes, it's more like a 4% interest rate, or 4.25%. You'd have to do the calculation to figure out how it hits you specifically. That's the type of detail that's going to change that. Still keep that what's higher interest, because we're all used to this artificially low interest rate on mortgages of 2.5%, 3%, 3.5%, even 4%. I can remember, guys, I refinanced into 4.75% on a 15-year mortgage. I have to go pull the year. I could go pull it out of my files. But I remember thinking, this is the lowest interest rate I'll ever have in my life. I'm going to look back and my kids are going to be like, that's crazy that you had 4.75%. Because remember, my first mortgage on the first house I ever bought was 6.75%. And then we got into this crazy period where 2s and 3s. That's not normal. I think it's pretty normal for mortgage interest rates to be in the 5s. But when you take into account the tax benefits, it's still low interest debt. It's still going to qualify under the financial order of operations. Go to moneyguy.com/resources or go to learn.moneyguy.com if you want the deep dive, and we cover stuff just like this. It's going to be step number 9, low interest debt. It's going to be after you make it through all the other 8 steps before you get to step 9. You didn't get us on this one, Kevin, and I hope that gives you the clarification to understand how unique mortgage interest rates are.
I also think that the type of asset that the debt is tied to matters, right? We get this question all the time as it relates to cars. Hey, I can go get a 3% loan for the next 7 years on a car. Is that something I should do, right? Wouldn't that be classified as low interest debt? No, the problem is because an automobile is a depreciable asset. It gets less valuable through time. Now, I'm going to say this statement, and this is not fully vetted, so team, get ready to edit if I screw this up, right? But I'm just thinking through like education, like a student loan, right? Your education does appreciate, but you don't get to sell it. You don't get to recognize value for the thing that the student loan bought. So I would argue that the longer a student loan lasts, it kind of is similar to a depreciable asset. Different than a mortgage, right? When you have debt on a mortgage, in most circumstances, home prices go up. They rise through time. I think you have to think about the type of asset it is and how long you want to be servicing debt on an asset that is really a dead weight. Because when you do your net worth statement, at least for an automobile, you can put the value of the asset in the asset side and the debt goes on the liability side. I don't think when you have a student loan, you get to put an equivalent asset for the education that you received on your asset column on your net worth statement. So I think you kind of have to think through that and quantify what is high interest debt and what is low interest debt. And that definition does depend some on the type of asset that the debt is resting on. The same could be said for business assets and business investments and so on.
I couldn't hear anything past when you said you need to think about your brain and your education investment as a diminishing asset. And I got really sad thinking about, is my brain diminishing in capability? Because that's you basically said we're all getting senile at some point. But here's the thing I would say. I would bridge it with, you're not wrong in the fact that I think from a student loan, thinking about student loan debt, there is a reason we have a maturity on that based upon what it's tied to. But I can tell you the counterpoint to the diminishing brain, because I've used this example with you, is if Brian Preston, who was a 28-year-old financial advisor, was probably the smartest version of Brian Preston from a technical knowledge. You couldn't stump me on all the income limits. You couldn't stump me on all the trying to figure out a 401k versus, all the funding requirements and so forth. However, Brian Preston, who's getting close to 50, the wisdom, I might not have the technical knowledge, but the wisdom gap that's filled in and the life experiences that get shared, because I got somebody who can go tell me all the funding limits. But that knowledge, it's kind of back to the... I
don't know what you think I said, but that's not what I said.
No, but because that's what he said. He said
Brian
that your brain, your knowledge, your brain is a diminishing, depreciating asset. That's why student loan debt. Y'all didn't hear that?
No, this is what I was saying. The education that you received in college was the diminishing factor. Meaning, if you had a $10,000 student loan today and a $10,000 student loan when you first graduated college...
Right.
You're certainly smarter today. That loan becomes less valuable through time as time moves on because that college education. Because right now, the asset tied to your brain is all the experience and all the wisdom, all the things you've built up. Not the textbook studying that you did back then. And the further away you get from that, the less valuable it becomes.
I still love that we get to have these discussions.
I don't think you're going senile. I want to be very clear on that. I don't think you're going crazy.
Well, okay. Well, that gets you past the Charlie Brown moment, because as soon as you ever have when somebody's talking to you about something, then all of a sudden whatever they're saying turns into Charlie Brown. Because you're like, did he really just say that?
No, not at all. Oh, that's amazing.
No, there was some creative license on that.
Thank you, Kevin, for getting that type of dialogue and discussion. Good luck, content team, turning that into a highlight.
That's going to be a great highlight, guys.